Hello, welcome to FountainFX on Wednesday the 20th of November 2013. I'm looking at the pound US dollar today. We're waiting for some significant news to come out about the US dollar later on, but I just wanted to share something around the use of the MACD, especially something called MACD Divergence. And if we look at the chart in front of us, this is a daily chart, and it's always the easiest chart to start to learn to trade from, because you're not dealing with all the constant ups and downs, etc., of fast move in the fast-paced daily market. You're looking at more of a long-term move. So if you look here, the top is just above the 162, the bottom of this channel is around about the 159. So it's a 300-point move, but it's taking roughly, if you think price gets to this level, and each one's a day, so we're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9. That's roughly 2 weeks from it to get from that level down to this level. So you know, you're not necessarily jumping in and out, making a bad decision and then putting your trade on, then taking it off, putting your trade on, taking it off, etc., because you're getting an emotional reaction to the market ups and downs. So it's a lot easier to be able to look and see levels and to be able to plan your trades in more of a calm and thoughtful approach. So what I'm trying to do here is I'm just trying to highlight something that's actually happened in the pound against the US dollar. If we look here, we've got a low, it's coming to the low here, and it's also coming to a similar low but slightly higher. So by drawing a trend line from the low here to the low there, we can actually see that that's actually a slight downtrend. It's not as flat as the trend line, the support line that I've drawn at the bottom shows. So there's a slight decline here. However, if we come down to the MACD that's at the bottom of the screen, and we do the same on the histogram, which are the bars, so these bars, the red bars and the green bars, are known as the histogram, and what they measure is the difference between the moving averages, these two moving averages. So like the moving averages here, the MACD has a moving average measurement, and then it also has a histogram which talks about the convergence and divergence of the moving averages. That's what MACD stands for, and it's a way of measuring direction in the market, momentum, so you can see whether or not it's a long trend or a downtrend, and you can see whether or not there's strength to it or it's not that strong at all. So here we can see that there was a strong downtrend at this point when price fell from here to there. There was a big push down. When it came back up into that area, not such of a momentum up. So that showed a very good opportunity to short at that point. We were in at resistance, okay, and the uptrend was insignificant at that point in comparison to what it was previously. So it was showing that momentum, the upward momentum, even though price had got into resistance, the upward momentum had declined. And I'll just show you that by plotting a trend line along there from the highs of this upward trend, so the highs of here, to the highs of the next peak. So when you go from peak to peak, what's the MACD doing? And the MACD showed that there was a decline in the upward momentum, because the peak of the MACD, as in the momentum upwards, was a lot lower from that one to that one. So what was that telling you? Ideal area to short at this point, because the upward momentum, the upward push, wasn't going to be maintained. And because we're looking at a daily chart, you had 1, 2, 3, 4 days in which to take the advantage to actually enter that trade. So it wasn't like, oh, I've missed it and the price has now run away with me. So that's the advantage of looking at the daily chart. You can actually take your time to see what the market's doing and react, so that you can gradually gain an understanding. You can take profit from it and you can learn. Now we're going to go back into this area here where it's come back down into this area of support, but you can see that there's a declining trend here. So the price, the low, has created a lower low, so it's pushing down. But what's actually happening to the MACD in terms of momentum? Well, as you can see at the bottom, by drawing from the highs, this or the lows, shall we say, this peak here, where it got to the bottom, the peak downward momentum was on this line here, which was at the bottom of this blue candle, as you'd expect. But the next peak, which is actually higher, peak of momentum down, is here, which is at the bottom of this red candle. I'll just double check that. Yeah, at the bottom of the red candle. So at the bottom, when price gets down to the low, this low here is not as low as the previous low. So it's showing that the actual downward momentum is now starting to decline. So it gives it a real clear indicator to say, actually, guess what? You need to buy, because the downward momentum is not as strong as it was, even though price is actually down at the previous level of support. So this is where you're talking about divergence, because price is pushing down, but momentum is actually pushing up. So therefore we're looking at an area where price is likely to turn in direction. And that's how you can use the MACD divergence, convergence, to be able to identify areas of entry. So in summary, you want to sell at resistance when the MACD's momentum is falling, and buy at support when the MACD's momentum is rising. We can see that again by the MACD's momentum here is rising and price is in at support. Here price is in at resistance, and yet the MACD momentum is falling. So that's another confirmation that this area of resistance is a good area to sell at, and that this area of support is a good area to buy at. And that's how you use the MACD, as confirmation of the areas to buy and sell. Thank you very much from FountainFX.